Yo, what's going on, everybody? It is Tuesday, May 14th. Market was up today. Very interesting trading performance from this morning. We got a hot, it was a hot producer price index up 0.5%. They were looking for, I think they were looking for up 0.3%. And that triggered a brief sell-off, and then the market came right back. So it looks to me like the market is trading short. And what I mean by that is that there's just embedded shorts in the market. You can't really knock it down right now very far. It doesn't. These sell-offs don't really last, and then it whips right back up. This is, I would say, not unusual when we're back near all-time highs. You get short selling by traders near prior highs, and that gets built in. And don't forget, there is an expectation out there now for rate cuts. And rate cuts, that is like the magic elixir for the monetarist zombies, right? I mean, they've been waiting. I have postulated, and this is me personally, I've postulated that a lot of the rate cut enthusiasm is already priced into the market because, like I said the other day, the market's been going up for the last 6 months, ever since the Fed announced a pause in the rate hikes, which was back at their December 16th meeting last year. We've been basically going straight up. We had a brief correction from the April 15th tax train, and we're still going up. So I suspect that a lot of the rate cut buying is sort of, before the fact. Like the expectation is already built in. That doesn't mean, like, if the Fed actually does cut rates, and right now the market is indicating that that's a possibility in September, you could get a pop higher by then. I don't know how long that will be sustained. I still stick to the scenario that the economy is slowing down. It's slowing down based on the drop in net government transfers, aka the deficit. All right. And we saw it in the first quarter. I'm very skeptical of some of the forecast, well, particularly the Atlanta Fed's GDP Now forecast for the second quarter. They're coming in at 4.2%. I don't know, like, I'm usually very much in line with those guys. So we'll see if they do any downward revisions. But in the last week, they actually did an upward revision from 3.3% to 4.2% in the second quarter. And frankly, I'm a little bit baffled by that. But we'll see. I mean, we're not going to get that data until late July. So there's still plenty of time for revisions. And I've said to you guys many, many times that the stock market will follow the economy. It's not the other way around. It may look like that in the short term, but over the long term, the stock market will follow the economy. One thing I saw today, which was very interesting, was that Biden announced tariffs on China, on some Chinese goods. And I remember back when Trump did this. And when Trump did this, what was it, like in 2018, when Trump did this, the markets went crazy, like on the downside. And we went through this whole entire period, this whole entire episode where whenever anything was mentioned about tariffs, okay, you'd see headlines daily or every other day. Whenever there was a comment or a mention of tariffs from the White House or officially mentioned, the market would crash. But now, nothing is happening, okay? I only bring this point out to show how kind of fickle and emotional and wishy-washy investors are. This is just another example of how, it's like what we're seeing now with the whole interest rate thing that we went through. With rising interest rates, that's going to be terrible. That's going to create a recession. That's going to create a depression. That's going to create a market crash worse than the great financial crash of 2008, 2009. And now it's like, okay, rates are high, no big deal, they could stay high. Okay, we've had a total reversal on that. But I just find it interesting that now, just announced tariffs on China, and Biden even said that he expects China to retaliate, okay? Never mind the fact that tariffs are inflationary, right? They raise the price, the import price goes up, and that's passed along to consumers. All right, here's a guy who's trying to, he's trying to have his team, which includes the Fed, to get inflation under control, and he's literally embracing another policy which is going to keep prices at a higher level, just like, massive record-breaking oil exports, which is keeping domestic oil prices and gasoline prices and energy prices in general higher than what they would have been without those exports, okay? But nothing in the market, no reaction. Whereas, 6 years ago, this was a terrible, horrible, a completely destructive, economically destructive thing. Now it's like no big deal. And I bring this to you to, once again, try to get your attention on the fact that the investors are fickle. One day something means something, the next day it doesn't mean that, it means something else. And this is why it's very, very important to really understand the factors that go into the economy. What drives the economy? What the true effect of these policies are. And that's what I try to bring you, okay? So it's a non-factor. Right now, everybody is focused on, of course, monetary policy, because that for 99.9%, I say the 100%, because we're nothing. We're not even a fraction of a fraction. For the 100%, that is the way they see everything. So this anticipation of rate cuts by the Fed. And I don't know, because Powell said today, we got to be patient with these high interest rates. Okay, he didn't really come out and say, you know what, we're getting closer to a cut. No, he basically told investors and the market, we're going to stick around with this for a while. We need to let it work. And now, so now, even that, when he used to say that just a few months ago, that was like, that would trigger a big sell-off in the market. But now suddenly the perception is, well, at least he's not saying he's going to raise rates. So yeah, high. Remember what higher for longer was like? A cascade of selling every time that phrase "higher for longer" came out. Now it's like, okay, higher for longer. At least that doesn't mean higher. So you got to be aware of this. Oh, there's my doggy friend. You got to be aware of this. This is all this psychological nonsense. And I cannot overemphasize how important it is to be perceptive, to see these kind of, hypocrisies in behavior, okay, or these contradictions, I should say, in behavior, and to know that it means something. I mean, you can't embrace an idea or a paradigm and say, this is written in stone, and when this thing happens, when A happens, it causes B to happen. Like when rates go up, it's going to cause a recession. And then when it doesn't cause a recession, you can't say, well, that doesn't apply anymore, or we look at it a little bit differently now because our view, our thesis was wrong, but we cannot come out and say that it was wrong. When you see things like that, you have to be perceptive, and you have to be aware of the contradictions, and that creates opportunity. Now, it doesn't create, if you're a day trader, no, it doesn't create opportunity as a day trader. But if you want a macro perspective, and when you see the contradictions, you have to go against those contradictions, because the contradictions reflect the behavior. So in other words, all the people that were selling last year based on interest rate hikes, and really selling since March 2022, all the people that were selling, they're all buying right now. And we know that last year it was admitted by many of the top people. Remember, I used to talk about this guy, Mike Wilson, the perma bear at Morgan Stanley, and others. I did many videos on this. It was admitted by these people that they got everything completely wrong. And now they're in the other direction, not because they really understand what's going on, but because they cannot admit, they're too prideful to admit that their understanding is completely lacking. So it's like they kind of ignore it, okay? They did admit, like, we got everything wrong, some of them anyway, and the media published many stories at the beginning of this year about how they all got it wrong last year. Not here, okay? But they all got it wrong. But they're too prideful to say, or to go back and to look at their analysis, whatever you want to call it, their research, their understanding, and say, gee, there's something in this that's just not working out. And now it's like what was bad is suddenly now good. And I'm telling you this right now, folks. What's good right now in their perception is going to turn out to be bad. Okay? I'm telling you this right now. You could take it to the bank eventually. But okay, having said that, tomorrow is a quarterly interest payment, so that's a big flow day. Tomorrow is a Social Security payment, so that's even a bigger flow day. So the market will make new all-time highs tomorrow. Oh, let me just add on there, tomorrow is also the CPI, the Consumer Price Index report at 8:30 Eastern Time. So if that comes in a little hot, we'll get a little bit of a pullback, but then it's going to go right back up. It's a massive positive flow day tomorrow. We're going to get new all-time highs. But I've been saying, I think those highs will be marginal. In other words, just slightly above the prior highs. It's not like, I don't think it's the start of a new leg up. I stick to the view that the economy is slowing down based on net government transfers now going down. And ultimately, the stock averages will move lower, reflecting that slowdown in the economy. So that's it for today, folks. Don't forget, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial of MMT Trader. I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT, and I show you how to use them to profit and invest in the financial markets. And please, I never say this. You're supposed to say it, from what I understand. If you please like and subscribe, okay? Everybody says it on their videos. I never say it. I'm a terrible self-promoter. Please like and subscribe. Bye.